Are you a Michigan taxpayer? Well, if you are, you're going to want to lean in for this one. In today's explainer, we're going to show you exactly how you can easily claim massive state tax savings while investing in education. We are talking about keeping real money in your pocket, and the best part is that navigating this whole process is surprisingly straightforward once you know the rules. Okay, let's dive into this because this number right here is the absolute headline. If you're a married couple filing jointly, you can literally reduce your Michigan taxable income by up to $10,000 per year just by contributing to a qualifying 529 plan. And hey, if you're filing single, you can still deduct up to $5,000. It's a massive financial benefit, but you have to know how to claim it correctly. Here is our roadmap for today. We'll be covering 1. Michigan 529 Plans Overview. 2. The tax deduction explained. 3. A step-by-step claim guide. 4. Real scenarios and examples. 5. Expert tips and FAQs. And finally, 6. Next steps and disclaimer. Section 1. Michigan 529 Plans Overview. Understanding your options. Right off the bat, to get the tax deduction, there's a golden rule. You must use an eligible Michigan-sponsored program. Out-of-state plans just do not qualify. And this brilliantly illustrates the 3 primary approved Michigan plans, which all offer the deduction but serve very different strategies. First up is MESP, the Michigan Education Savings Program. It's direct sold and grows with the market. The real standout here is the extremely low average fee of just 0.09%. That is way below the national average. Second, we have MAP, the MI 529 Advisor Plan. This one is also investment-based, but it's sold through registered investment professionals. And third is MET, the Michigan Education Trust. This one's unique. It's a prepaid tuition program. You're literally buying tomorrow's tuition credit hours at today's rates, which is a fantastic hedge against inflation. Section 2. The tax deduction explained. The core mechanics. So how does this actually work? Well, claiming this deduction directly reduces your adjusted gross income. Since Michigan has a flat state tax rate of 4.25%, every single dollar you legally deduct saves you 4.25% rate then and there. As we mentioned, individual single filers can deduct up to $5,000 per year and joint filers up to $10,000. But here is something absolutely crucial to remember. This limit is per return, not per beneficiary. So even if you're married filing jointly and your funding accounts for 3 kids, your maximum total deduction across all those accounts combined is still capped at $10,000 for the year. So the crucial point is understanding what the state calls the netting rule. You see, you can't just deduct everything you deposit if you're also taking money out in that exact same calendar year. The actual amount you're allowed to deduct is calculated as your total contributions minus any qualified withdrawals you made during that same tax year. It's like a seesaw. Keep this rule in mind because it's going to be super important when we talk about strategy in just a bit. Section 3. Step-by-step claim guide, filling out Form MI 1040. Okay, let's tackle the paperwork. It's just a straightforward 3-step process. Step 1. Apply that netting rule we just talked about. Total up your contributions and subtract any withdrawals for each account. Step 2. You're going to locate Michigan Schedule 1, which is your additions and subtractions form. And Step 3, this is where people tend to get tripped up, you have to enter the data on the correct line. If you use the investment plans like MESP or MAP, that total goes on line 17. But if you made payments to a MET prepaid contract, that goes on line 18. Oh, and for MET, you can actually deduct the initial processing fees, but late fees definitely don't count. The government doesn't subsidize us for being late. Let's move to and see how this builds your overall tax return. Once you've figured out your total subtractions on Schedule 1, that final number gets transferred directly over to your main MI 1040 form. Specifically, you're looking for line 13. When you enter it there, you are officially reducing your taxable income, effectively locking in those savings before your final tax bill is even calculated. Section 4. Real scenarios and examples applying the deduction. We know married parents can deduct $10,000 and single parents $5,000, but take a look at this third scenario. Grandparents. The beauty of this system is that anyone can contribute. If grandma and grandpa want to help out and they file jointly, they can claim up to a $10,000 deduction on their own Michigan tax return. The catch? They have to make their payments directly to the 529 plan themselves. You can even use platforms like YouGift to make this whole process incredibly secure and easy.
Now, we need to talk about something you absolutely want to avoid, the temporal trap. Because of that netting rule, if you drop $10,000 into the account in August and then pull $10,000 out in September for fall tuition, your net contribution for the year is 0. no deduction for you. To maximize your Schedule 1 subtraction, you have to practice temporal segregation. Put the money in by December 31st of one tax year, and then wait until the calendar flips to the next tax year before taking your distribution.
Section 5. Expert tips and FAQs. Maximize benefits and avoid pitfalls. Let's rapid fire through some expert rules to keep you out of trouble. 1. Prioritize those in-state accounts to get the deduction. 2. Make sure your contributions hit by December 31st. Now lean in for 3 and 4 because this is a big deal. Federal law recently changed, allowing 529 funds to be used for K-12 private school and for Roth IRA rollovers. But Michigan does not conform to these federal changes. If you do a K-12 payment or a Roth rollover from your Michigan plan, the state considers it a non-qualified withdrawal, and you will get hit with a 4.25% state tax recapture, so watch out for that. And finally, number 5, just remember account balances are capped at $500,000 per beneficiary. Here's a question we get all the time. What if my kid wants to go to an out-of-state school? Honestly, don't worry about it. While you have to use a Michigan plan to get the tax deduction, you absolutely do not have to spend the funds at a Michigan school. You can use MESP and MET funds at any accredited university, community college, or trade school in the country, and even at some approved international schools.
Now, what's really interesting about this slide is a highly anticipated legislative update. Starting April 2, 2025, Michigan officially conforms with federal law regarding student loans. This means you can use your 529 funds to pay down student loan debt up to a $10,000 lifetime limit per individual. That is a massive game changer and adds so much flexibility for Michigan families.
Section 6. Next steps and disclaimer. Protecting your finances. Before we wrap up, let's quickly cover our professional disclaimer. Everything we've discussed in this explainer is strictly for educational purposes. Tax laws are complex, they change, and everyone's financial puzzle is a little different. You should always consult with a certified tax professional or financial advisor to get personalized advice and make sure you're fully compliant with all the latest state laws. Let's end with this fantastic thought from Robin Lott, the executive director of MET. Every step you take to save early is a step toward opportunity. When you understand how to navigate the Michigan 529 tax deduction, you aren't just lowering your tax bill today, you are quite literally funding future opportunities for your kids. So I'll leave you with this one question to think about. Are you leaving $10,000 of tax deductions on the table this year? Because if you are, it's time to take action. Thanks so much for joining me.